Good morning, ladies and gentlemen, and thank you for having me here today. It's a pleasure. I'm Lovén. I head up international corporate strategy for Liquidnet. Liquidnet is an institutional equities broker. We facilitate large trades for institutions all over the world. We trade for around 650 of the largest asset managers. These firms are predominantly pension fund and mutual funds operating on a global basis. When we look at regulation in general and MiFID II in particular, we tend to look at this from three different angles. The first angle is obviously for ourselves as a firm. How will this impact us? How will this impact our business? That's probably more relevant for us than for you. The second thing is, what's the impact on our client base? As I said, our client base consists of large asset managers. What these firms do is that they professionally manage and invest funds, pension funds, savings for millions and millions of European individuals, and outside of Europe for that matter. The third thing we look at is, what will the impact of this be for the market as a whole? Are these proposals and the implication of these proposals generally a good thing for the market? Will they create a well-functioning, stable, transparent and safe market, whilst at the same time keep creating innovation and growth? And that's really what I want to talk to you about today, and hopefully continue to discuss on the panel later on. So by going into that, I want to take this all the way back to basics, if you like. First of all, what is the fundamental purpose of capital markets? It's the fundamental purpose of capital markets to create a way for companies to efficiently seek capital, grow, invest in new ventures, and thereby contributing to the economy as a whole. And on the other side of that, to have a marketplace whereby investors can safely supply capital for these firms to grow. Or is the purpose to create an outlet for speculation? What we've seen over the past decade, I would say, is that there's a shift from an investor's market to a trader's market, from more of a long-term fundamental market to more of a speculative market. Now, these two aims have always existed and coexisted in the market, and there's a need for both. While the long-term maybe is the fundament of the market, there is a speculative angle that needs to exist to exploit inefficiencies. I think the problem is, how do you balance these two so they coexist and work together in a good way? And more importantly, how do you not benefit one on the expense of the other? I think MiFID II has a unique opportunity to redefine this relationship somewhat. If we go back to 2007 and look at what MiFID I set out to complete, it was really about harmonizing European capital markets. It was about improving competition, and it was about decreasing trading costs. I think most of these things were achieved, at least to some extent. When we look at MiFID II, it's my understanding that we now rather want to look at things like creating a transparent market, create clarity in the market, stability, and deal with risk in a different way. All of these things, which I believe that almost every person in this industry welcome a lot. I think the question comes to when you go from your high-level aims into your low-level directives or requirements. So, what are the trends that regulators and policymakers have to deal with in the market today? What is the changing environment? We have a lot of new models and we have a lot of new technology, and this field has pretty much exploded over the past decade. These are some of the trends that we see, and these are some of the trends that we feel are very important to point out in this discussion. First, we've seen a reduction in traditional trading volumes. What does that mean? When we talk about traditional trading volumes, we refer to the long-term institutional investor. We've seen an increase or a maturity of what's referred to as high-frequency trading. High-frequency trading is a broad definition. Some call it exploiting inefficiencies in the market, some call it market making, some call it a mix of both. We've seen an explosion in the evolution of various products and various technology. Algorithmic trading, and the extension of that is the low latency rates, so on and so forth. But all of these things have led to a changing market environment, a changing market structure. We've seen a lot of new venues. We've seen a lot of consolidation, exchange consolidation. Some of it we're in the middle of right now. We've seen a lot of new alliances and new offerings. There's many things that can be mentioned. One thing that we did is we created a rather unique cooperation with the Swiss exchange with the aim to bring what used to be OTC block trading back on exchange in a more transparent and organized way. So there's a lot of interesting things coming out of this. Now, if we talk about, that's the fundamental reasons for the market of being, that's the good things that the market bring versus the structural trends we see in the market. How does this fit into regulation and how does this fit into the debate we're going to have today? Well, the reason that we exist is that there is a fundamental issue that a lot of market participants face today. This fundamental issue isn't new and it's existed for a very long time. We call it the supply and demand imbalance. What that means is really equities market globally is geared toward a retail type of environment. When you are a large investor, a pension fund or a mutual fund, and you want to buy, let's say, 10 million shares of something that trades in lots of a couple of hundred shares on the exchange, you have a problem. You can't put this order on the lit market. It would be detrimental for you. It would affect the price, it would affect the market, and it would have a very negative effect for you. There's a person called Kevin Slavin who explained this problem in a very interesting way. He said it's a bit like playing poker but being forced to go all in all the time. It's quite dangerous. So there is a need for pre-trade transparency. That's been recognized over a long time. This is what many of these firms use. Basically saying my order, my investment decision is so big that it would be detrimental for the market as a whole if I were to reveal that to the market. That needs to be traded in a different way. That's the type of trading that we conduct. It's what's called block trading or large in size trading. Now, there's an opportunity here to make this more efficient, and what we want to say in terms of regulation is let's capitalize on that opportunity and let's keep that in mind when we talk about regulation and transparency. The solution is new market models that we've seen over the past years. Liquidnet is one of them. You have certain others. It's a way of, in a very fair and efficient way, creating a market for large trades that can't easily be executed on the traditional exchange. This used to be called OTC trading. OTC trading is still a large part of this. Now it's done in more regulated way through MTF, through brokerage, so on and so forth. And to put this problem into context, let me just give you some numbers. If we look at the institutional sector, the sector that I'm talking about, and we go back 25 years and look at their assets under management, over these 25 years, their assets under management in equities have grown about 40 times. During the same time, we've seen trading in these shares on the traditional exchanges going from the average trade somewhere around 50,000 euros to, depending on where you look today, somewhere between 3,000 and 10,000 euros. Now, to put that into context, the average trade that we execute for this firm is well over €1 million. So this problem keeps getting worse and worse, and there needs to be a framework in the market to deal with this. So, how should this be dealt with in terms of regulation, in terms of new policies? Well, when it comes to new regulation, we want to look at two things. We want to look at responsiveness and we ask for clarity. Now, we think that there is three things that is extremely important for policymakers and regulators to get right when they adopt new regulation. The first thing is speed. These markets are moving so fast today that there is a need for regulation to be adopted quickly. It cannot take years and years for something to come into effect because the market have already moved. Regulation needs to keep up with the market rather than chase the market. The other point is regulation has to be made accurately, meaning the policies or the requirements that's being proposed has to be in line with the overall end goal. And I think we can all agree that the overall end goals set out in MiFID I and MiFID II are good, overall good things for the market. The third thing is it has to be adopted throughout the whole market. So if we put in European-based regulation, it has to be adopted by all the European member states at the same time in the same way. We didn't see this fully in MiFID I, and we hope that that is something that would be adjusted in MiFID II. I think that's one of the most important things. So when it comes to clarity, again, this comes back to what's the difference between the main goal up here and the detailed proposal that gets inserted into market as a requirement. It's really three things I want to highlight. It comes back to what I talked about in terms of the long-term investor market versus the traders market. How do you regulate for these things to coexist at the same time? I think what's important to say is, let's take an example like Valerie referred to before, which is the algorithmic trading example. High-frequency trading uses algorithm as a mean to implement their strategies. Algorithms does not equal high-frequency trading. If you look at the institutional sector that we trade for, around 30 to 40% of their investment decisions are carried out through algorithm trades. These trades do nothing but try to efficiently either buy or sell a stock in the market. Now, some of the detailed proposal that we've seen, or details in this proposal that we've seen, would be very counteractive to this group. When they're trying to buy 2% of Nestle, they don't want to be a market maker. They don't want to be forced to post and buy and sell orders. That's not their business. That's not what they do. They need to be able to use this technology, which is one of the biggest evolution in trading over the last decade, to efficiently implement that trading decision. The other thing has to do with investor choice and flexibility. Regulation is important in the way that we believe it should create a solid framework for professional investors to be able to choose in a safe way the offering and the product that works for them. Let's go back to the example of the institutional investment fund who needed to buy 2% of Nestle. They need to be able to use a product that can achieve that for them in an efficient way, rather than be pushed into a retail-sized market. Why is that important? Well, it's important for all of us at the end of the day. We should remember that these firms, what they do is manage money for millions of investors across Europe. If you look at the average European investor, his largest exposure to the equity market is not through his online dealing account that he uses once a month. It's through his pension and his mutual fund savings. And that's why that's very important. And the third thing I want to stress is we need a level playing field for all market participants. I don't believe we have that today. And when I say that we need a level playing field for all market participants, it doesn't mean that everyone should be regulated the same. But what it means is, if you conduct similar type of business, then that business should be regulated in a similar way. Thank you very much.